to a new episode of Under 360 English. Today we are going to discuss about what are the factors, what are the things you have to consider if you are a part-time investor. Who is a part-time investor? There is no specific definition for that. But generally we consider part-time investors as the investors who have the affinity towards investing in stock market. On the same time, they are engaged with their own business or their own job, but there is no scope or time for them to regularly monitor the investments. That means maybe they will monitor the investment. They may look into the stock market investment once in a month or once in a quarter or so, in that way. So if you are an investor like that, what are the factors you have to consider before investing or before selecting a particular stock for your portfolio? That's what we are going to discuss in this episode. So stay tuned, keep watching. Many of the experts I have taken this from the book written by Benjamin Graham. The book name is The Intelligent Investor. So this book has been published in the year 1949, and that describes the strategies to successfully use value investing strategies in stock market. The strategies or all those things may be outdated to some extent, but still the theme of that particular book that holds good and gives a lot of vital guidance to any of the investors at any time. So the part-time or passive investors, that the systematic name is something different. Even Graham called as a defensive investors. So according to him, defensive investors are the investors. Let me read from his book itself. Defensive investors are the investors who are unwilling to put the time and effort behind the investments. Such investors don't prefer an active approach to invest, and like a portfolio, they needs minimal research and monitoring. Hence, they tend to see conservative investments as they don't require too much effort. That's a simple thing I told about the passive or part-time investors. They don't have, these kind of investors don't have time, they don't have the attitude to continuously involve in their investment options. So the investments that they are doing, that must be very strong. They should have a guarantee that after a couple of years or so, also that particular company, that particular stock will sustain there, that will not deteriorate, their financials will not go down. Most investment experts, they recommend that investors choose investments based on their risk tolerance. We know that the passive investors or these defensive investors, they only expect average returns. That's the main reason why all these defensive investors, part-time investors, they prefer mutual funds, because fund managers will look into the matter. The investors need not take the headache of the stocks they select. Let's discuss about the 7 stock selection criteria for this kind of part-time or passive or defensive investors. The first criteria that should be met is about the size of the company. If you are a passive investor, if you don't have time to continuously look into the financials of the company that you have invested, then you must exclude the stocks of all the small companies, all the penny stocks, small cap stocks, even mid cap stocks, as they might be subject to more than average fluctuations. So larger companies are more stable in their earnings. Also, the market sentiment towards such companies are generally optimistic and positive. But these larger companies, they will not surprise you with earnings jump or anything. The earnings may be, or the guidance may be much expectable. But on the other hand, your money will be safe on that particular bigger companies. The second criteria you have to take into consideration is about the company's current ratio. So basically, current ratio gives you a popular measure of a short-term liquidity of that particular company. This is a very simple ratio. It's a ratio of assets to liability, assets divided by liabilities. What is the inference of this? So basically, current ratio is the measure of the company's ability to generate revenue to pay off all its debt in the near term. And the acceptable current ratio levels are something like in the range of 1.5 to 3. So look for such companies to invest if you are a passive investor. Now you may be thinking why the current ratio has been fixed as 1.5 to 3. because higher the current ratio looks better in general sense. But as we know that if the current ratio is less than 1 means the company is finding difficulty in getting the funds to meet the near term expenses, because current ratio is nothing but current assets divided by current liabilities. But on the other hand, if the current ratio is more than 3, that indicates a company is failing to manage its working capital or assets optimally. The money is or the assets are idle in nature. So a good current ratio indicates that the company had a lower risk of insolvency and making it better for the defensive investors. The third criteria you have to take into consideration is about the company's consistent earnings. For the past 6 to 8 years, the company should be able to generate good earnings numbers, at least a positive earnings numbers. In that case, you can consider it for investment. Moreover, make sure that the fluctuations in earnings are also less, maybe less than 10%, especially the negative fluctuations. The fourth criteria is about the dividend payment history. The defensive investors tend to generally prefer to invest in high dividend paying stocks because they usually seek a steady flow of income from their investments. But they must pay attention to the dividend payment history of a company before investing that particular stocks, because sometimes some of the companies, they have a tendency, promoters have a tendency to pay dividend by taking loans, so that the company can come into the limelight and the share prices will go up because of the demand. So share dividend payment history does matter. So you please consider the company has been paying dividend for the past 8 to 10 years consistently. If so, you can consider that company for investment. The fifth criteria you have to look for is about the earning growth. A defensive investor should invest in companies that are increasing their profits consistently, because this is an indication that the company is heading towards the right direction. So at least 25 to 30% of earnings growth should be shown on every year. In that case only you can consider that company for investment. The sixth vital consideration is about the price to earnings ratio, PE ratio. We know that many investors look for stocks with low PE ratio, but it cannot be the only factor to consider. But still, to be on the safer side, it's better you consider the stock with the PE in and around 15. To say plus or minus 3 to 5 you can consider. That means 10 to 20. That range you can consider, since you want to invest in a safer company. But still, this is not a hard and fast rule, because sector specific PE you need to consider. In some sectors the PE will be very high, so you need not think that that's a disqualification. But still, if you are a person who don't want to take risk at all, in that case you can consider the PE in the range of 10 to 20. And the seventh criteria is nothing but price to asset ratio. The price to asset ratio is not used as a common factor to evaluate the stocks, but this is came into existence because of the emergence of IT companies. It's easy to evaluate the companies which are in the traditional mode of operations, like consumer staples of energy or any of these companies which are capital intensive. But price to asset ratio gives much of the overview about a company's intrinsic value for a defensive investor. It's always better you keep some stocks in the watch list whose current market price is less than 11 times of the last reported book value. But if the company has a PE below 15, then it might have a higher price to asset ratio. Also, one more thing you have to keep in mind, that it's one more parameter. Just for an addendum, you can consider that the product of price to asset multiply and price to book value should be less than 22. In that case, you can consider that as a safer stock. Now you may be thinking that why should I take this much efforts? Instead of that, I can just select some companies from the Nifty and put it Nifty 50 and invest my money on that. It's true. The probability of risk emergence may be very less. But still, you have to keep one thing in mind, that even index stock has been fallen. Even credible stock has been removed or that has been shattered to ground. Like Satyam, at least they got some capital on that. Unitech, no one ever expected that Unitech will be shattered like this. So you do your own research and find quality stocks as per your needs. That gives you confidence. Don't leave your jobs to someone else. So see you in the next episode. Till then, bye from Anup.